Hello, everyone.
Yeah,
So, good afternoon, everyone. For those of you that were there last week, welcome back. We're going to be doing something slightly different this time around. We have Henrik joining us as well to give us a little bit more of a macro overview of what's going on. And the idea is to basically go through this in a couple of different steps, starting with Henrik's macro perspective of where we stand, where the market is currently sitting, where it's likely to go. We'll go through some of the stuff that we touched upon on the last webinar as well, linked more to the, let's say, the tooling of Swissblock and how we combine together all these different factors. And we'll end with a deep analysis that Willy is going to be able to provide with liquidity. But before we start, I wanted to just quickly give you a fast disclaimer as well. And just wanted basically to note that this webinar does not constitute financial advice. Everything discussed reflects only our personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation in this is voluntary, and information that we provide is indeed for educational and discussion purposes only. And today's session will be approximately 45 minutes. We'll try to get through it a little bit quicker to leave more time at the end for Q&A. So I think we had some great Q&A questions the last time around as well. I'll start with Swissblock. So for those of you that were not there last time, we are a proprietary fund based out of Switzerland. I'm one of the co-founders of Glassnode as well, and have been in this space for 10 years doing a lot of research and focus on cycles and structure. So we've been hyper optimized in really trying to understand Bitcoin from a structural and liquidity perspective. And we'll go into what that means in a second. Henrik?
Yeah, and I'm the macroeconomist at Swissblock, and try to get an understanding of where we are going with the economy, and that's supporting our market outlook also. So, that's what I'm here for.
I'm Willy Woo. I've been in the Bitcoin space since 2013, done a lot of the early on-chain pioneering sort of metrics. Been working with Glassnode, which is actually founded by the Swissblock team. So that's been over 5 years of working together with this team. And so we've been very much studying Bitcoin's liquidity over the last 5 years very deeply. So yeah, that's me.
You that just joined, we'll have this structured into 3 different steps. We'll start with macro, go into how macro leads into crypto and Bitcoin specifically, where we stand in a historical perspective, looking at the last 4 to 5 years, previous cycle, this cycle, and we'll end with the liquidity analysis that Willy Woo is going to be showcasing as well. And before we actually do that, before we start, if you have any questions, just write into the channel. We'll be aggregating those together, and we'll be answering all the questions that come in the second half of this webinar. So with no further ado, Henrik, take it away.
Thank you. I want to take you through some thoughts on how we look at the economy, because I think I've said many times to Yann that when we look at the economy, it's not something that is shifting like a speedboat. It's a super tanker. A super tanker, we know that takes a long time to turn up and down, and you can actually track that. You can track how the economy moves up and down. The business cycles are of key importance, as I see it, to how we are to analyzing markets, understanding markets. And this is where the business cycle model is of key importance. Up here, we have the leading indicators. We have these 3 guys here. We need to move them out here first for it. So first, we have the leading indicators up here, which is yield spread, housing data, and so on. These are the ones that will lead us into where we're going with the real economy. And what do I mean about the real economy? The real economy is employment, it's manufacturing levels, it's GDP numbers, and all these things. These things that we know on a daily basis that we follow and see and understand as, okay, is the economy in a good stage? And then we have the lagging indicators, which is inflation, yields, rates. This is something that especially the Fed does not understand, that actually yields is something, or there's something that declines after the economy actually has started to roll over. And you can see how that actually works here. You see, we have the economy moving down, and then we see the yields are moving down. Now, I know this looks like a lot of lines and so on, but bear with me for 1 second here. We have the red line here, and we have the horizontal line. These are the ones that are important for all these, for all the lines, for all the 3 areas. When we have a crossover of the red line with the horizontal line, that is a signal from the leading indicators. Now the Titanic has hit the iceberg, and the ship is going to sink. It has never been wrong. These are quarterly data. These are not for timing. This is not for timing the market, but it's about to tell us that the ship has turned, and we are now seeing the developments that will become stronger and stronger, and there's unfortunately no turning back. Every time we see that crossover, it's followed by a crossover in the real economy, which means that the economy falls into a recession. The gray areas are the recession periods that we have had. So when we see that crossover here, we get a crossover here, crossover, and you can simply follow it here all the way, all along. And even Corona was something that it picked up. See, this is quite powerful, because if we know where we are with this, we can understand then we have a situation where we are below equilibrium and rising up through the blue line. Then we are above equilibrium and declining, rising, and then we are above and declining, and we are up below and declining. These are the four phases, and it just goes up and down and so on and so forth. You can see how when the signal comes in, for instance, into the financial crisis, it came in November 2006. Did not mean that we had a recession immediately. It meant that now the ship hits the iceberg. There's no turning back. Then the model then went on and said, actually, we have a small strengthening of the real economy into 2007. For those of you that has as much gray hair as I have, we remember that as well. And then we saw actually we fell into a recession. By December 2007, the model predicted 2007 November. And actually, if you look at it, it's been pretty good here. May 1999, July 1990. July 1990 was the real recession. February 2001, March 2001, November 2007, December 2007, November 2019, February 2020. And now it says up here, we have hit the iceberg, but we don't have the crossover. When everybody was so bearish, we remember that in 2022, I could look at this and say, the leading indicators are all the way up here. The coincident indicators are still rising. There's no way we are in a recession. This time around in April, when everybody was again falling over their own feet in terms of calling for a recession and a bear market, I said, well, we do have the rollover of this, but we haven't seen the rollover, the touch of this yet. We are still above the equilibrium here. It was a harder call, but it was still, if we look beneath the hood of these, quite easy, because we did not see the deterioration in the economy that was needed. So this is not a timing tool, but this is a framework that will help you stay on the right side of the trend, on the long-term trend. So where are we now? We have the crossover here, which means that we are heading into bad times. It can last a while, because when we have the crossover, we know we can take 2 to 4 quarters before we get the crossover of the coincident indicators. And actually, here in 1987, it took a little longer. So it's only an indication of the direction of it, but bearing in mind that it's never been wrong. So now we're waiting for what can we see then in the coincident indicators, meaning employment, meaning manufacturing level, GDP growth, and so on, that will start to show us that we have this slowdown. Well, the Fed apparently does not see it so far, but we've seen how the ECB is out already and trying to stimulate the growth quite a lot and been lowering rates over the last many months. We can wonder why the Fed does not see the same. But what happens into this late phase, which we are in right now, is that liquidity is starting to be pushed into the economy. This is where the central banks are starting to say, okay, we need to save it. We'll add liquidity to it, and then hopefully we'll get the trickle-down effect by asset prices starting to move up, and we will get a good situation for the situation in the economy will change. I just have to say it never happens, not according to my model, but that's the hope that they have every time. So what we see right now, if we move on then, is that we have liquidity coming in quite aggressively now. And if you look at, this was in 2020 when we had the aggressive move in liquidity. This is global M2 for Fed, Bank of China, Bank of Japan, and ECB. And we see how that pushed up, and that has, and as Willy and Yann will tell us a little later here, that has good effects on what we saw with assets and in crypto and in Bitcoin. Now see, at this point here, late in the phase, is where the liquidity starts to come in. And we have already seen about 4.4 trillion in the first 5 months of this year of M2 liquidity coming in from these four central banks alone. So things are starting to happen because they know that they have to start to stimulate the economy, trying to avoid what I think is an unavoidable a recession, a slowdown of the economy. But this is what I see from the macro side. Late phase, liquidity is coming in. Doesn't mean that we have a bear market immediately. And this is where a lot of economists make a mistake, because they think if we have bad data coming from the leading indicators, that means that you have a recession tomorrow. That is not how the economy works. It works as a super tanker, and we'll have to wait for the deterioration that should be coming in the coincident indicators.
But I wanted to do as well to take what Henrik just said and actually tie that together with the way that we actually look at Bitcoin. And for those of you that were there in the previous webinar last week, we've defined Bitcoin as a canary in the coal mine for liquidity expectations. So whenever liquidity expectations go up, the need, or let's say the appeal for Bitcoin goes up as well, for many different reasons, right? That can be because of the need to access alternative ways to invest. It could be that it has to do with deviations or inflection points between the way that currency pairs trade. It could be that the people are trying to circumvent restrictions that they have locally, like in South America, Venezuela, so on. But what for us is really, really important is to understand how that then ties into how Bitcoin trades. And to be able to do this, so what we basically do is that we tie together two fundamental pieces that are absolutely pivotal in defining Bitcoin and the canary in the coal mine to liquidity. You can see that over here on the right side, where we map external factors, and this is macro, what Henrik just reviewed, together with on-chain factors, which is on the y-axis. And what we basically do is that we try to track that relationship over time. And as you can see, what is really interesting with the current situation is that we've actually gone full circle back to the same area that we were in mid-May. And the reason this is important is because in mid-May was actually the end of the first basically move up that we had in Bitcoin. If you guys can remember, the bottom was actually on April 7th. And I'll go and explain again how we identify that with the framework that we use to track Bitcoin and look at the Bitcoin structure. But it basically is similar to that end of that cycle and the beginning of basically the distribution cycle that we've basically been in for the better half of the last 3 to 4 weeks. And this is very important as well to note, is because to have a sustainable alt season and to have a sustainable real move of liquidity into the system, you really want to be in the upper left quadrant. The upper left quadrant is basically where you're basically unpegged or decoupled from macro environments, which is something that we want to be, an independent strength in crypto, together with really strong idiosyncratic liquidity and flow into the system, where you have a lot of activity that drives price and eventually also drives the price in alternative assets like Ethereum, so on and so forth. What's also interesting when you look at it from that perspective is that what we're seeing today is also a story of relative strength in Ethereum. So we're not just talking about strength in Bitcoin, but for the first time in a very long time, we're looking at strength in Ethereum. And you can see that actually in terms of a structure here. You can see the blue area that indicates a dominant strength in Ethereum. The last time that we really had that was to some extent in November of last year, but predominantly very strong in February and March of the beginning of 2024. That was the last time we really had an idiosyncratic move away from Bitcoin, as Bitcoin still was strong. We had a distribution liquidity into Ethereum and eventually we actually had an alt season. We're actually in a similar type of situation right now. But you can also see in terms of the actual underlying structure of our framework is that we have a very similar type of setup when you look at the bottom layer here, where we look at our actual idiosyncratic systematic strategies that basically track the strength in Bitcoin relative to other things. And you can see that also back in February and the beginning of 2024, you had a moving out of the gray signal, which is a conservative signal on the momentum of Bitcoin, a moving out of the blue signal, which is a robust systematic strategy that we have that gives you a relative understanding of how strong or how weak Bitcoin is. And the same thing with the red curve, which is an aggressive variation of that. And what we do is that we usually look at the combination of those things to get a gauge of how strong on a short and medium term Bitcoin is. And 9 out of 10 times, the market is driven by Bitcoin, but 1 out of those 10 times, it's actually driven by Ethereum and then alt season, which is actually what we are looking at, or let's say the first innings of that. What's also very interesting, just to kind of look at that from a more holistic perspective, to segue into the analysis that Willy Woo will do on the liquidity side, is that we are still in a very strong on-chain environment, but we are seeing the onslaught or the beginning phases of profit taking in a redistribution phase. So you have a lot of people that were buying and that took a lot of risk between April 7th and April 10th of this year that have now made 30-40% gains that are now reducing their exposure because we're in a more volatile environment. And that volatility is basically something that you can see also through our altcoin and our Bitcoin vector reports. We are basically in this breakdown environment. So we're not in a downtrend, but we're in a breakdown. A breakdown basically signifies a environment that is very volatile because you have a lot of profit taking, a lot of new market participants that are coming in trying to buy cheap Bitcoins, so basically buying the dip, and you have the struggle that goes on. And at some point, one of those two facets wins. And that's basically what we're going to be tracking very, very carefully. If the profit taking gets stemmed, we will have the beginning of a very big up move as well in Ethereum and consequently altcoins as well. So having said that, we might come back to this framework at the very end just to tie everything together. But I think this is the time, Willy, to look at the liquidity side.
So just a reminder with what Yann said is that we're here where Bitcoin is not really being moved by external factors of global macro, and it's actually not being moved by its internal investment dynamics. So what we're in is kind of a purging, right? It's let me just pull this up actually. So the purple here, what we're tracking here is the speculative, casino games played on derivative markets. So that what we saw actually was we had this huge run up that investors drove and really tail on to this move, probably with an expectation of breaking all-time highs. We had all of this paper flood into the system with long demand. So this is what we're measuring inside the purple is paper bets, long demand weighted. And so they came in and were purging this sort of speculative activity right now. And actually what we're doing is the whole game that's moving price around right now is tactical. Basically liquidating as many trade positions as possible. And so you can see that this heat map is really showing where the liquidations, with price moves into there, will liquidate. And so we're just hunting all of this right now. And so, when we were moving up here, there was a patch here and it took that out. And it didn't actually take this patch out. So there's still potentially a big magnet trying to take this out. So in the short-term game, it's a tactical war between traders. It's very profitable to liquidate people. So the traders are doing this right now. And so we need to wait for this to pass. And this is our readout right now. Actually, there's actually a little bit of uptick right now of more people buying long positions through paper trades. So I'd want to see this get below the baseline here, ideally down into here before we're really good for a swing upwards. You can see whenever we're in the zone where we've purged all the paper bets out of the market, Bitcoin is free to move upwards from real investments without parasitic hitchhikers on the back of it. And so we've got a bit of time to burn in terms of let's turn on SOPR. SOPR is what it's measuring is between actual investors on chain. We can measure that the amount of profit is being transmitted or burnt when they're selling out of their position. And so generally this peaks runs through a peak, and then as it rolls over, that's a sign of profit taking as coins are being distributed to new investors even though they're carrying less profit. Okay? So what we're doing right now since the first peak here is that we're getting profit taking, investors are profit taking, and we're in this phase now. And generally when you get down to near zero, then they stop selling. This will give you, the rate of this drop. Who knows what will happen? The trajectory might change. They may decide not to sell and hold their coins. But right now, this is telling me we've got a number of weeks well into July before it looks like this phase of cooling down from such overheatedness, going from 75 to 111, 112 in compressed amount of time. We're just cooling down from that. The profits are being taken, the speculation is being pulled out of the system. And so that's the phase we're in. The Hawkeye is telling us that we're in the center zone. It's not being pushed around by anything because we're just playing trading games and getting the traders out of the system. In terms of actual fundamentals, what we're looking at here are the inflows into the Bitcoin network. And it is certainly not pivoted bearish. This is a bearish pivot, right? That's when The capital flows are now reducing. There's still coming into the network, but like I said last time, it's like a updraft. Skydive is coming into a wind tunnel, and the updraft is the capital pushing it up. And so even though the capital's still coming in, it's coming in at a lesser rate. So the buy pressure is reducing, the price is coming down. We're not seeing that yet, but it certainly tapered off a bit. Potentially, we could be in a medium-term bearish pivot if this starts to cool down, but right now that's not confirmed. And so that gives you an idea of fundamentals. Obviously, the next few weeks are not going to be driven by this, but it's going to tell us what's going to happen maybe 2 to 6 weeks out. And so here's much more of a cyclic analysis of the long run, and it's a risk signal. But this risk signal is built on measuring liquidity in Bitcoin's network. So what we're measuring here through on-chain dynamics is effectively the buy-sided liquidity. And also comparing that to shorter term price movements to get a really good read on it. And you can see that bear markets and actually leading indicator to a top, the buy side liquidity is starting to taper off. In actual fact, the real buy side of liquidity started to taper off over here. But what was happening was paper was buying and selling, and what it was paper that was the paper bets was driving this up, even though the real investment had gone away. And where we are now is we're in late cycle, confirming what Henrik is saying, is that the liquidity is not there. The buy side of liquidity is not there compared to like early in the cycle here. So the risk is climbing. It doesn't mean we're at the top. It just means the countdown timer has started. We can go all the way back to 2017. And you can see the countdown's timer started here, even at 2000, 3,500. And it can pull back down and you get another run up, right? Like inside here, it can drop and then price runs up, right? And so, but that'll give you an idea of where we are in the cycle. No one knows when the top exactly will be, but the timer has started, and any dip here will likely mean we've got more room to make another up wave. But we need to be very, very careful because we're certainly not like in 2022 or early 2023. It's hard to guess when the top will be, but we're in the later innings of this bull run.
And to tie that together, Willy just said, it's a slowing down in Bitcoin, and it doesn't mean that Bitcoin has stopped here. I think we're just going to be grinding higher slowly as other things start picking up, and this is where the alternative investments like Ethereum, layer ones, especially DeFi as well, LSDs. If you follow our Twitter channels on Bitcoin Vector and Altcoin Vector, we go deeper and deeper into this as we progress into the coming weeks. You're seeing a lot of revamping of liquidity being absorbed by these individual projects, which then creates a flywheel into the higher levels of the utility part of DeFi as well, right? And that spreads like wildfire into everything else. So that creates a positive feedback loop until Bitcoin then starts progressing the distribution, or let's say the profit-taking phase that Willy was talking about at the end of whatever happens in the next 3 to 4 weeks. So being able to pinpoint that and get the early signals when these things start turning is absolutely primordial, right? And that's what we specialize in as a team, especially with together with Willy's liquidity perspective, and also Henrik's general cross-sectional macro and economic perspective. And to tie those pieces together again, if you look at the underlying view of the market right now, we are in a general recovery phase. So if you look at the whole top 350 liquid assets that basically comprise the 90% of the volume in crypto, we're still in that recovery. There's not a lot in risk area because yes, we have had a drawdown because of the volatility that you saw from the Iran-Israel conflict that we're currently going through. It is not something that has changed the underlying structure. So it is something that you have to be aware of. And I think you have to always risk manage, right? So you have to understand that you can still, within a price range, be within volatility bands where you can get 10, 15% drawdowns, but it has not changed the underlying structure, which is very, very important. Again, we are in a breakdown, not in a downtrend, which would be very, very different. In a downtrend, you would have very sharp spikes down in Bitcoin, and you would not have relative strength in alts. That relative strength, as you can see here, is right now in Ethereum. So Ethereum is driving the behavior. And what's also very interesting when you look at it from a relative perspective, Bitcoin is cooling off, as Willy Woo stated before, especially if you look at liquidity. So liquidity has been coming down actually since the beginning of June. So June has been a distribution phase where the investors that have come in between early to mid-April all the way up to the end of May have started to take profits as things start cooling down. And as those profits start getting taken, there's also been a simultaneous shift into other higher opportunity cost plays like Ethereum. And you saw that as well in terms of the ETF flows, which is very interesting. You had a very large uptick in consistent flows into Ethereum ETFs with all of the SEC activity around DeFi, the fact that they really want to put DeFi at the core of a lot of the, let's say, the innovation that's going to come down the pipeline, the integration of new stablecoin systems onto the Ethereum platform in general, let's say, DeFi applications, which in itself is just going to create a flywheel right into the future. So I think right now, very important to look at. And also, to Willy's point, one of the key things that I think we have to look at when we talk about global tops is going to be what we call the impulse signals as well. So looking at Bitcoin as the cornerstone, but then looking at alts in an aggregated fashion and see how exponential the price discovery is of those altcoins. So how exponential is the microstructure in price? And what you look at here, the blue curve, is the aggregation of the top 350 liquid altcoins. We aggregate them together, create a index, and it tells us when basically the price aggregation of these altcoins becomes unsustainable. So think of it like an elastic band that gets stretched too far because everybody's in full FOMO and everything is awesome mode, and then that elastic band very quickly snaps back as Bitcoin corrects. And this is basically what this is picking up. So you see that the blue usually lines very, very well with tops, global tops in Bitcoin. You see that here as well, and here as well, right? Even though the altcoins, I think Bitcoin had a lot of idiosyncratic strength this time around, also because of Ethereum. And you also align with the bottoms, which is also very, very important. So that's where the red curve comes in. So it's the exact same aggregation, but in terms of the negative elements of that exponential trend that you see in altcoins. And basically saw that, as we mentioned before, the 7th and the 8th of April, which is the actual real global bottom that we've basically seen. So having said that, I know that we covered quite a wide variety of different things. For those of you that are interested, we have different services and subscriptions that deal with each individual one of these verticals that we just discussed, and also the cumulative verticals. So with the altcoin Bitcoin vector, we have the SEM service series that Henrik is leading, which is a really curated, high impact, high value, basically personalized macro service that basically allows you to really understand all the intricacies and all the things that are actually happening on a cross-sectional way in the economy, also the financial world, and then also tying that together with crypto. So for those of you that are interested, we can have a discussion afterwards through email as well or Telegram. Do we want to maybe go through the questions, Will? Yeah, so let me maybe start with the first one. So explain altcoin vector. So basically, as we mentioned before, we've been doing research now for about 12 years in this space, and we've been really hyper-focused on really understanding Bitcoin from a cyclical perspective, but more importantly, from a liquidity perspective. And what we've basically realized is that liquidity is like it's like a snowball that comes down the mountain. And every time the snowball gets bigger, there's more elements that it absorbs and it releases, right? In terms of the material that makes the snowball bigger or smaller. And the altcoin vector is a really important component in understanding Bitcoin, because at the end, what you really want to understand is where the liquidity is being concentrated, and when the price is moving down, when liquidity is getting distributed, right? When you're in a profit-taking phase, where that money is actually going. Is that money going into altcoins, into more risky type of place, or is it going to stable coins and cash? Because people are going risk off. They're worried that things are not progressing in the way that they believe, and they're trying to take chips off the table. The altcoin vector is super important, is a super important piece of information within that general understanding of where the liquidity goes when it isn't in Bitcoin. But as I mentioned before, 9 out of 10 times, it is about Bitcoin. It is about understanding liquidity in Bitcoin. And that's where the Bitcoin vector becomes super important and needs to be a kind of a fundamental piece in your in your research article. The next question, Henrik, I follow your work on X and YouTube. I'm
That's quite
pretty
long. I've
much
been
on the
reading
same
it.
page. Oh, you have been? Okay. So
So I
maybe you
think
can
I think
summarize.
I think basically the question is why would I expect this slowdown? Why couldn't it be that, or a recession even? Why wouldn't it just be like like 1995 to 2000, where we kind of see that we just keep going higher for some time? First of all, I just want to say that in that period we did not see, you couldn't, I don't want to show the chart again here, but we did not have a recession signal there in 1995. Also, you did not have the yield spread inversion back then. So there are clear differences from that period at that point. And the 10-year yield will not just stay above something. It's not something that the Fed decides. The long-term yields bonds will be dependent on what's happening in the real economy. So when the real economy starts to roll over, and you can take a chart and look at that, you'll actually see how the long-term yields actually start to decline well after that you've seen the economy starting to roll over, and then the long-term yields come down, and they keep declining into way into the recession and after the recession even. That's because they are lacking the real economy, and that has to be due to the capital demand and supply and long story. So I don't see that this is 1995 to 2000. I see this as a situation like into the financial crisis. Actually, it has a lot of similarities to the balance sheet recession that we saw into 2007 and 2009. The housing market looks terrible in the US, and frozen solid, as I see it, and is a deadweight anchor on the economy. So I don't think there's going to be a soft landing or anything like this. I think we're going to roll over it soon. And the next one, maybe also Yann says here, why the Fed is not seeing, beats me. I really don't understand it. As you can see, if you take the two charts, looking at the rates from the two central banks there, you'll simply see that there is a big difference, and the Fed has not been cutting. I think the Fed has been have gotten afraid of their own ghost, the inflation that they think that they unleashed. And now they're being too hawkish, and they are thinking that they can micromanage the economy. And now we are at 2.4, and we need to get it down to 2. I mean, I think it's almost arrogant to think that they can micromanage to that degree, thinking of how big the economy is and what can potentially happen. So I think that if you look at the inflation level at this point here with the slowing economy, that the Fed is wrong. I think I'm more on the ECB side here, that they have started to stimulate, and I think that is correct, because inflation comes down after the economy starts to roll over, and also the European economy has not been as strong as the US. So probably that's also why it's that the ECB has moved ahead a little before.
Next question: can we have access to a live read-only version of Hawkeye based on subscription tier? So one of the really good things about the framework that we built together within the group with Willy Woo, Henrik, and the general Swissblock and Glassnode teams is that we have a very robust central framework that has been iterated on and perfected over the last 10 to 12 years of basically trial and error, figuring out what makes this asset class different from everything else, and understanding the place that Bitcoin has within the larger asset class space, right, within a portfolio, and how you actually manage that from a risk perspective. So what that allows us to do is that it allows us to look at things in a relative sense as well. We can compare Bitcoin versus alts, Bitcoin versus equities, and anything in between that as well. So what I would suggest for those of you that are actually interested in Hawkeye is actually subscribing to Bitcoin Vector. If you're interested in alts, to the altcoin Vector, and also to SCM, because we will be releasing a lot of that alpha into those groups, because, especially when the focus area is on Bitcoin or altcoins, right? So we're going to be making sure that when we see a top, for instance, when we start seeing that things are degrading, that we're going to be able to actually represent that through the framework and through these different services. Obviously, we will also be doing some alpha leaks through Twitter, but the majority is going to be for the paying customers, because this is a lot of compressed value, right, at the end of the day. What are your targets and time windows for this Bitcoin cycle? I think Will, I think you can probably give some nice color on that one.
Yeah, this cycle, and as far as I can tell, is different. Because when we talk about cycles, we're talking about number one, the supply shock from Bitcoin's halving, and now that's we're actually at half the inflation rate of gold. So I don't think that supply shock is very relevant relative to the buy pressure of corporate treasuries even, or sovereigns. So I think that's gone away. It just so happened since its inception that that halvening was synchronized with liquidity cycles and global macro. And so, as Bitcoin's now a multi-trillion-dollar global macro asset, I think the correlations with global macro and the liquidity flows between it would dictate it. And so I'm not really looking at cyclic analysis anymore. Just tracking liquidity. Did that answer the question, or was there something more to it?
There's actually a subsequent question asking about the cycle itself, and if we believe that we're going to see a famous parabola, right? Kind of like a blow off top.
Oh, okay.
Yeah.
Okay. No. No. The last parabola is 2017. And the reason for that was that after 2017, actually the top was around the CME launch, I think. After 2017, we had derivative markets. So if you think about it, if everyone wants to buy Bitcoin, the only person that could sell it to you 2017 and earlier was someone who actually bought Bitcoin. A very rare individual bought Bitcoin from 2017 and early, and they pretty much understand the asset very clearly to have bought it so early. And so you're going to have to convince them hard by raising the price exponentially to before they start to unload a little bit of their Bitcoin. So you had an imbalance of demand and supply, and that's why we got exponentials. You saw that also in altcoins, but as soon as paper markets came in, anyone could front cash as collateral and then sell it to you as a paper contract. And so there's infinite cash in the world, so there's infinite selling pressure potentially if everyone wants to take that bet. And you'll see that the last cycle, 2020, 2021, it rolled over as the paper started to flood the market. And I've got charts of that. It just showed open interest went through the roof, paper flooded the market, and that expenditure got sort of watered down, dumped on. And so, no, we're in the world of global macro. You can absolutely short it with derivatives and options. So we won't see extensions again.
See more rounded tops. What we will see for sure is these euphoric moments. You're gonna see some alts outperform, right? You can still see the 5s and 10x's, but they're not going to be as ubiquitous. It's going to be more isolated, right? So you're going to have the narratives that are going to be very important. That's actually one other thing that we track, and just to quickly show the people that asked for it the last time as well. If you can see my screen, what we do as well, which is very important, is understanding relative narrative perspective. So as we said before, right now DeFi LSDs are super strong compared to everything else. That is very indicative of pre-alt season. You see that every single time DeFi had a peak, it preceded a big spike in alts. Same thing here. Same thing here. Same thing here in basically September of 2024. It was the first kind of the test alt season before we had it in a stronger way in November. And same thing back in early 2024. So whenever you had a strong rise in DeFi narrative, you also had within 2 to 3 weeks, you had a follow through in the rest of the alt market. And the reason for this is that it creates a flywheel of liquidity that then basically expands the balance sheets of people that have reserves, their treasuries in Ethereum, etc. Then all of a sudden they have more capital than they actually planned with, right? In terms of the capex for investments or whatever, and that excess money can make its way into speculation into the system through lockups, TVL, or also direct diversification. So that's something that is super important to track. Something that we track internally as well. We'll be doing this indirectly through the Bitcoin Vector and also Twitter, if you follow us. Let's see the next question. The explanation, do you see 2017 as a possible template for 2025? I think Will already answered that. It's very difficult to get another 2017, like the really intensive blow off top in Bitcoin, but that doesn't mean that you can't get a very strong Bitcoin environment, right? So it's just going to be very different just because of the type of market participant that is in the space, the level of sophistication, and also the sophistication of the instruments, like Will mentioned, which I think is an absolutely key point. But I still think, right.
Yeah, and also we have to think about the capital sizing right now. Is that every cycle, let's call it 10x bigger, and so right now we're scaling up to $8 billion on the high end per day coming into the network. And so when you think about what moves the needles now is, the hundreds and trillions of dollars in wealth assets, some of that liquidity is flowing in. It's not really these mums and pop retail buys right now. It's these large pools of capital coming in. And look, they're not going to degen FOMO into it. They're going to have very, very staged buying, right? And so the buying is going to be less FOMO'd. And so, that's generally when you get this sort of FOMO race of everyone market buy before it goes up even further, that's generally a retail phenomenon. We're in the realm of institutions, and they tend to do regular, consistent buying. Like as you can see with MicroStrategy, for example. So it's a different beast, it's a different type of entity that is buying now. And so we're talking about, we're measuring buys in fractions of billions of dollars.
Important point that Willy just made. It's really the type of approach, right? The way that with sophisticated allocators, the way that they actually move into a position and move out of a position, and not only through sophistication of the underlying instrument that they use, but also the time horizon, right? They're looking at this as a strategic allocation, not just a quick in and out. So I think that changes the underlying environment as well. Let's see the next question. Yeah. So in terms of the add-ons, for those of you that asked about the altcoin vector, yes, you can. We're actually going to be launching a pricing tier where it's going to be a lot more flexible to be able to add on and kind of bundle different services or reports together, which I think is very important because, again, you need different things in different times. The cool thing about our framework is that you can tie all of that together in a very simple to understand framework, right? So yes, we will be making that available over the next 1 or 2 weeks. I think the next one is for you, Will. Your tweet, Willy, on the possible end of the classic 4-year Bitcoin cycle really caught my attention. Could you expand on what you're seeing that points to this change? Are we entering a new phase of Bitcoin? Ties together with what you just said before. It's the institutional phase through treasuries.
Yeah, that's right. It's kind of the comments I've just said earlier is that the internal supply shock, and I've always said that this is like Bitcoin has a 4-year resonance, and every 4 years there's you pushing the water in a bathtub and it sloshes like this. But every 4 years you're only able to push half as strong. And now it's such a small push that you're not really going to maintain that slosh in the system. And it's really the outside forces pushing. You call it the wind or something, blowing this water around. That's global macro. And so there's two effects right now is global macro in terms of what Henrik is measuring is these cyclical events of recession and liquidity expansion. But there's also this other overlay of it, which is this new asset class, which is only $2 trillion and probably going over 100 trillion. And there's an adoption S-curve of that capital coming in. And so we've got the cyclical activity and we've got nation states waking up. We've got to have this as a strategic asset. We've got, an absolute gold rush from public treasury companies coming into it. And so it'll be kind of a balance between the cool liquidity events of global macro and actually this inrush, this adoption curve of capital. This is why Bitcoin is outperforming gold, given similar properties. Bitcoin, I'd argue, is way better in terms of scarcity. But look, gold's reached saturation. It's been around for 6,000 years as a monetary asset. This thing's brand new. It's only been, 16 years? And it's only just starting to get global macro allocation because it's got the regulations, it's got the custody, all the parts are in place now, and the regulations are now no longer an issue. So those are the two things. Used to be halvening and sort of global macro. Now it's global macro and inrush of TradFi allocating.
There's actually a follow-up question to that, Will, that just got asked right now. Just out of curiosity, do you have a read on how many of the BTC whales that are currently new within the system, say past 2 to 3 years, are actually new versus old? And will that change the
Right.
BTC price dynamics in a bear market?
Look, this is a Glassnode question. Look, the building blocks for that indicator is there, but that has not been built. Like the age of the whales, we're just tracking how many whales there are, whale count. So does that have a bearing? Well, I believe it does, because ultimately, when an old whale or a new whale is rising, if an old whale selling, or it could be, retail or miners, but when you see a new whale arise, what you're saying is that there's a very, very large, a whale is 1,000 Bitcoins. That's $100 million allocation at the very minimum. It's a sophisticated player, and when they allocate, that is actually a increase of capital that's flown into Bitcoin. Like we can actually measure how much capital Bitcoin is holding every day very accurately. And so when you get someone who's bought their coin for $1,000, they put $1,000 in, right? And now it's $100,000. Someone new buys that one Bitcoin. It's $100,000 of new capital minus that $1,000 that was taken out the network. So when you see new whales arise, that's just capital inflows that we're measuring coming into this network, right? And this is gonna go from, I think it's just a shade under $1 trillion of capital that's been stored in the network. Never mind the market cap's 2 trillion. That's $1 trillion of allocated capital, a shade under. We'll break that in the next few months. And so how much is going to come into Bitcoin, we don't know, but we can take guesses, given there's Michael Saylor's figure is $900 trillion of wealth assets. I think that's overinflated, just the way that the underlying measurement, but certainly more than 300 to 500 trillion dollars of investment assets, and a lot of that's coming. And then obviously the market cap will expand with multipliers because the way markets work.
There's actually another follow-up question to that point as well. What are your targets and time windows for this Bitcoin cycle? This cycle shows much more steady appreciation on the trend for BTC, missing the famous parabola, like you mentioned before, obviously. Do we see the same in 2025? Is retail and macro environment ready?
Well, I can say we're not there yet. But again, it's actually Henrik. I'll probably rely on Henrik more because we are really global macro driven. Once he's starting to see top outs in his more timing signatures of global macro, then we should be worried. I have the risk models which are detecting liquidity within Bitcoin, but it's a very leading indicator, but it doesn't tell you the exact top. And then I have midterm indicators that show the capital's like starting to wane and drop, and even sometimes pull out of the system. That's very rare. But you never know whether that's a local sort of fluctuation or a major one. So you want to correlate that to what's happening in global macro. If the entire system is starting to risk off and the capital's pulling out, then I'd be concerned. But I have no crystal ball of when that will happen. We're now talking global macro. That's every participant in the world. And I've yet to see a genius that predicts everything moving forward, even the billionaire guys that have executed.
Exactly. And to just add to that point, I think the framework that we propose is really kind of, when you're on the road and you have kind of a sign that comes up and says trouble ahead, like, warning, risk of an avalanche. That's exactly what it does. So it tells you when the probability of something happening increases significantly. But there are no guarantees, right? Markets are stochastic by definition, right? They're massively intercorrelated random events that basically come together that create outcomes, right? So it's not our job to predict with accuracy. It is our job to weigh the probabilities of certain catastrophic events or euphoric events to happen. And like Willy said, all of that comes down to understanding liquidity, understanding how money moves through the system, gets locked in Bitcoin, as Willy said, with $1 trillion, and how parts of that or fractions of that move into Ethereum and the other altcoins for very short periods of time. 90% of the time, it's Bitcoin. That other 10%, altcoins matter. Will altcoin cycle top in Q3 or Q4? Most likely. Maybe Henrik, that's a question for you, tied together with what Willy said before about the recession.
Yeah, I mean, I think that again, if we look at the business cycle, that how close we are to it, to actually rolling over, then we had a signal for the leading indicators in November of 24. What does that mean? Then we latest will have the recession in December of this year. Maybe could that mean then we have a top 2 to 3 months before that? Could it mean that we have a top in September, October, November, maybe something along those lines? I could see. So I don't think it's here. I also again lean up on what Willy just said, but I think there is a push higher. I think we're going to see all-time highs also in the equities. There's still strength there, even though we may have a sluggish summer. But I see it pushing higher into autumn as well, and I think altcoins will move with equities as well, and maybe even have a blow off top for themselves, and an extreme move into the final phase, a Q&A kind of thing to the final move. So gone to my head around late Q3 maybe.
And to that point as well, I think the final act is always happens in multiple steps. So there's increasing probability now that we will see something of a sort of a catch up towards Bitcoin from Ethereum and some of the other alts into end of June, potentially beginning of July. And then you have a final act of this final inning towards Q3, towards the end of Q3 potentially. That's where kind of roughly what we were talking about in terms of time window. Now, as Willy Woo said before, this is where obviously our framework and the constant analysis through our framework becomes very relevant, because we'll be able to understand if that timeline is being accelerated or decelerated, depending on how altcoins, liquidity, and macro tie together into how price discovery happens in Bitcoin once we go over all-time high. There's another question came in, I think, just based on this current discussion. What are your thoughts on Bitcoin's movement in relation to the global M2 money supply? Which cycle does the global M2 typically follow? I'd appreciate hearing your perspective on this. This is basically, Henrik, I think, just the correlation with M2, right? So
so we have all seen the charts out there on Twitter or X, which shows this kind of correlation, and I think it makes sense. I mean, more liquidity come into the system at that point, and that drives Bitcoin and altcoins up. Makes sense, and you can see the correlation is quite strong. So I think that's fine. Which cycle does the global M2 typically follow? As I said, when you start to see the deterioration in the coincident indicators in the real economy, that is when the Fed starts to become worried. That's when the ECB and the rest of the world already have started to move, because normally you'll see that the US is the last man standing. So there's already starting to see the signs of that in other central banks starting to push liquidity, make it more accessible for people. And I think that is why you'll see sometimes there's another famous chart out there that shows that when liquidity goes up, then the business side goes up as well. It's not entirely correct. It's actually the period there where you also have a slowdown in the economy, but because liquidity will not save the business cycle, not save the economy. So it will follow in the last phase of the business cycle where we are now. Typically, that's where you see M2 liquidity coming in abundance.
I'm quickly writing into the group here on the chat where basically the services that Henrik is doing with SCM. This is the link to the website. So you'll find everything under products under Swissblock.net. If you're interested in Bitcoin Vector, altcoin Vector, we have also Hawkeye and demo subscriptions that you can subscribe to if you're interested in having a deep dive with myself and actually PMs and experts, so portfolio managers that are actually actively using these tools to make portfolio decisions, and then also SCM with Henrik. So there's quite a wide array of different elements that you can look at. There's a second, so there's people that were asking about sample reports. So we will be creating a sub part of the website where we're going to be releasing all the older sample reports to get an idea of how the progression works, and then potentially also a video that goes through the advanced services, so the Telegram groups, where we basically update you on the framework that the report is built on, and we update you on a daily basis. So for instance, if there's a shift between strength in Bitcoin into Ethereum, or let's say from Ethereum to L1s, you'll get an alert that gets triggered and that gets sent directly to your Telegram. And like this, you're always up to date with how things are shifting, between the week that the publication hasn't been updated, right? Because remember that the Bitcoin and the altcoin vectors are weekly publications. So for the Swissblock fund, we're not taking external money. We're proprietary, but we will likely do something along those lines in the coming year. So 2026, we'll be releasing something. If you're signed up to our email list, you'll be made aware towards the end of 2026. Yeah. So if you want to buy all the services, yes, as we mentioned before, we will be doing bundling and packaging. So this is going to be something that will be released within the next week or so, hopefully, where you can basically subscribe to all the services together to have the full global view of what's going on from a liquidity perspective. In terms of bottom targets, because this is more of an educational webinar, we don't want to give specific targets, but to put it in a very specific way, Bitcoin is a liquidity transfer mechanism, so it's very sensitive to expectations of liquidity, like M2, very different ways of defining liquidity, which basically means that in a recession, when you have a massive contraction or receding of the waters from the beaches, right, so to say, that's going to affect Bitcoin in a significant way. So in a recession, Bitcoin will not perform very well, but it will perform very well in the basically when the recession ends, right? When liquidity moves back in and people start looking for hard money, but not during the recession.
And this is actually where also, just to build on what you said, where the business cycle model, there was another question on that as well.
Yeah.
It also will help us to understand when is it that we see the real bottom. When everybody's the most fearful, we'll start to see the signs of new growth coming in the leading indicators, which will tell us, okay, now maybe starting, and that will also help us, position ourselves for that uptick after you have seen that kind of deflationary bust. So it's not just to pick out the tops, it's also to pick out the bottoms.
Thoughts on your current state of the bond market? Do you think we are entering stagflation or not? We'd love to hear your opinion, Willy Woo. So maybe Willy Woo and Henrik to give. Yeah,
that's Henrik.
Yeah.
That's Henrik.
Okay. Stagflation is not just something that's just going to come out of nothing. I mean, stagflation is something that's going to come when you see that the money circulation is going to pick up. And that requires that the consumers are actually spending more, and you are starting to see that the pockets are just open and they want to spend. I don't think that is the situation we have at this point here. I don't think the whole talk about this with inflation and so on. I see a bounce maybe inflation at this point here, but everything points to also the business cycle model here that we are seeing a decline in inflation levels. So I don't think you'll see stagflation here. Stagflation means stagnating economy and inflation that moves up. That's not what we see. We are down to 2.4%. That's not stagflation. 3% inflation is not a problem at all for the economy. What we're talking about when we say stagflation is that when you have zero growth or negative growth and you have 5% inflation, that is a problem. But that's nowhere where we are. We still have positive growth, and we have an economy that is where inflation is actually historically low to the point where we are in the business cycle. In 2001, before the recession there, and in 2007, before the recession there, inflation were up at 3%. It actually boomed up, it bounced into, I think, 4 or 5% in 2007, and then it rolled over strongly into the recession. So we talk about stagflation at this point here is ridiculous, honestly. I have to say it like this. But what we can see is that what comes after, when the Fed comes out with their bazookas with liquidity, is that the economy does not react to it as fast. Why? Because we have seen inflation, because we have seen yields going up, because we may see unemployment going up. So if all of us, we start to spend a little money, save a little money on our mortgage loans, do we want to go out and spend that immediately, or do we save it and say maybe we'll wait spending it for a rainy day? And I think that's the psychological effect that is going to create a situation where the economy will not be as ready to take on the QE, and then we just go higher. It will actually be a more stagnating bottom what we're going to see for the economy. And in that environment, I could definitely see a stagflationary kind of scenario. But we are a couple of years down the road. It's not going to be immediately here.
Segue maybe also to a point that Willy Woo made. There's another question, Willy, where they basically say, how do you quantify Bitcoin's future demand and its impact on Bitcoin's price? So I think it goes back to the amount of capital that it absorbs. I think that analysis is going to be super key in defining potential future price evolution.
Yeah, so you got to do a very, very long-term view of it, maybe out 20 years, maybe it's a guess, and based on the trends of how it's gone logarithmically on a log chart. And so I think it'll take 2 decades from here to reach any kind of equilibrium. We're far from it right now. And I put together all of the prior credible studies on Bitcoin adoption in terms of head count, like how many entities had exposure to Bitcoin, and it goes all the way back, right? Because the early work goes from day one of the Genesis block, and we could measure these entities clustered together. This is the work of Glassnode. So very high resolution. We had daily stamps of how many people were in it, and it was like growing at 10x. You can measure the 10x growth every so many months, and then became 6 months, then became a year, and so forth. And then later on, when exchanges came along, you couldn't really exactly measure it because it's dark data, but there's global surveys by Cambridge with their work there, surveying the whole industry and so forth. There's been different credible surveys. And so the last time I did this and then extrapolated the growth rate were around, I think, 4.5 to 5% of the world's global population having exposure to Bitcoin. It's quite surprising, right? But we're in that, when you're looking at the adoption S curve at 5%, you've got this kind of early pioneering stage, which will pass, and early adopters, and then you've got the early mainstream. So somewhere in there we're at, right? And so in terms of this S curve, it's still very early, and we're only at $2 trillion. And then you just look at the amount of capital in the system, and I'd call it 400 to 900 trillion, depending on how you measure it. It's very difficult to measure it because everyone's using broad paint strokes. Like global equities is 110 trillion. It doesn't include private companies, only public companies. You've got Bitcoin at 2 trillion. I would remind everyone that you're counting it twice because MicroStrategy has some Bitcoin, and now that's multiplied by two because of the MNAV in the equity markets. You've got real estate at 250 trillion. I don't know. The bond market is, a lot of that real estate is bought on debt. Now we're counting bonds again against that asset again to create that. So it's all of a sort of a circle jerk of counting it. So I would say realistically, maybe in the 400 to 500 trillion of real capital. Once that gets sort of the capital gets pulled out of it, that's going to collapse heavily because you're counting things twice. And then when you bring it into Bitcoin, and so you draw the sort of picture out. And I do agree with Plan B that in today's value, if we measure it in 2025 dollars, it's going to be around 100 trillion, might be 150 trillion. But that's where I think of it. And you just have to map how quickly. I give it 20 years, and you get an idea of the growth of this market cap.
Let me actually share a piece of research that we did back in the day. This is a report. I'm more than happy to send this out with the webinar video if people are interested. This is from August 2020, where we basically proposed a path as to how Bitcoin could get to 100K in a sustainable way. It took longer than we predicted. We thought it was going to be 3 years, ended up taking 5 years. But what's super interesting is that at the end, even if you look at it in terms of a size of a country, at 100,000, in terms of the amount of electricity that it's currently consuming, you're basically actually in the top 10 now, I think, right? If I'm not mistaken. So it's basically the most secure network in the world. It even surpassed our expectations in terms of how we were projecting it. But the most important thing, which is very interesting with this analysis, we did a demographic analysis as well in terms of the type of cohorts, millennials, Generation X, how their saving pattern and behavior would actually transition into this new way of, this new type of money, because this is like it's an evolution of money. Like this is not just currency. This is really money. Like it revolutionizes the way that we think about money, the way that we use it, and the way that we incorporate it in our culture. Right? And if you kind of look at that in a proportional sense, This is what 100,000 Bitcoin really looks like. So if you look at it in terms of the institutional investors in the US, if 0.8% of the capital gets deployed into Bitcoin, only that moves it to 100,000, right? And this is back in the day when we did the regression models. It would take only 1.6% if it was only private investors in the US. So basically, people that have 401ks that want to invest 2-3% of their net worth. If 1.6% of the total private wealth in the US is invested in Bitcoin, that would have also led to 100K. So this shows you how little it takes and how large the money pool really is that Will was talking about before, right? And remember, these are 2020 dollar values, right? So 2025, I think I would argue you can add another 10, 15, 20% on top of this, right? So it just shows you how early this really is, and that the adoption cycle, like Willy said, can absolutely take 10, 15, 20 years before you absorb everything, because we're so early and the mechanisms are now really starting to move. The flywheel is starting to move and it's starting to absorb the things around it. So every cycle, it does one step further. Now we're in the treasury cycle. So we went from the speculator to the private individual, the retail. We went to the early funds and family offices. That was the last cycle. Now we're in the treasury cycle. So basically corporate entities that come in, and the early innings of nation states through sovereign wealth funds. And it's going to end, whatever the next cycle is going to be, into 2030, 2035, with nation states and actual massive, large investment vehicles through sovereign wealth funds, etc.
And we've got these great tailwinds. If we're talking about a 20-year time frame, like we're kind of coming into this end of a long-term debt cycle, right? Like the world's deciding on what will be the next world reserve currency. And so in those times, everyone runs to gold. Bitcoin, everyone's running to Bitcoin as well in this time. So, it's not out of the question that the next world reserve currency is either backed by Bitcoin or it is Bitcoin, in my opinion. So we've got tailwinds.
And also, absolute massive tailwinds. And also there's a question on stablecoins as well. There's what we think about the stablecoin super cycle. I think that's an absolutely massive innovation. I think people do not understand how big that actually is in terms of its ability to actually revolutionize the railways and the plumbing of the financial industry. So absolutely, that's going to be a massively important thing. And just to kind of, as an interesting fact as well, if you really think about USDT and the amount of treasuries that USDT holds, the projection is that I think it was 500,000 or 1 million. If Bitcoin goes to 500,000 in terms of the value per coin, USDT as an entity is going to own more treasuries than the Japanese government owns today in debt, in US debt, basically, in T-bills.
Yeah, I did this.
So that's massive.
If Bitcoin goes to $1 million, and give it 10 years, say, to be safe, 10x over 10 years is pretty conservative. You think about Tether. It's like this is something people just think it's a stable coin. Actually, what Tether did was they came in 2014 and solved the banking issue because no one was banking these exchanges. So they handled the banking rails, and banks were shutting them down. They had to go to find new partners and so forth. Then they tokenized it, and then you had the likes of Binance go to $1 billion business in 1 year because they didn't have to deal with banks. So actually, all of Asia, where all of the offshore exchanges that do insane volume compared to the rest of the world, was built off Tether. They accelerated crypto 4 years because they sold banking rails. So what you have now is, if you want to be in Bitcoin or crypto, the other side of the book is Tether, because everything of volume trades against USDT. So if Bitcoin is going to $1 million per coin, from here we're going to need 10 times more of the other side of the book, which is Tether. And so when you look at that, their AUM could potentially grow by another 10x from its 150 plus billion. And you work out that AUM in terms of buying short-dated bonds, they'll displace China. So, and they'll also be more profitable than the five biggest banks put together. So yeah, it's a pretty big thing to watch Tether right now to see how it evolves. Given that they made $13 billion last year, they start to become immune to interest rates because a lot of that 13 billion was buying Bitcoin and gold and watching that rise. So as Tether's surpluses comes back into its AUM, they can over collateralize by buying higher earning assets like gold or Bitcoin. They're one of the biggest Bitcoin holders. So they can continue to outperform on their treasury despite yields dropping if they drop. But we don't look like that doesn't look like that's happening for a long, long time.
And to add on to that point as well, there's another question that came in about if the US government decides to kill Tether for any reason, how much value can BTC lose? It's actually, to Will's point, that's actually less and less likely to happen because the US government, there's a symbiotic relationship now between Tether and the US government because the Tether is buying more and more basically long-dated US debt, right, through basically their treasury buying because they have to basically secure, let's say, the underlying for the tether peg. So it becomes more and more symbiotic to the point where Tether becomes indispensable to the US government and for them to continue, a servicing debt, but also creating debt and being able to actually monetize their system.
And to that point, as a bullish signal of what Yann just said, is that the guy, Howard Lutnick, who's running the new sovereign wealth fund for the US, bought 5% of Tether. So that's going to open a lot of doors.
Yep. The Trojan horse becomes the standard.
The Bitcoin bank buys all the banks.
Crazy. What else? I'm trying to go through so I think one of the last questions, like, how does your analysis evolve with the changing market structure? I think it goes back to something that Will said at the very beginning, which is, we started with understanding the underlying things that made Bitcoin different, which was on-chain, understanding flows, how this complex dynamic system evolves, becomes or evolves into something more complex. We have all these different types of market participants interacting with each other. But then we realized over time, as the instruments became more complex through the introduction of the CME futures, like Will mentioned in 2017, that there's multiple things that start driving the value proposition, right? Because as the plumbing becomes more complex and more sophisticated, it allows for more mature market participants to come into the space. And I think what is super important with a framework is that you always have to build it on principles, right? And really strong foundational principles that will never change, that define the system for what it is. But at the same time, really make sure that you're always adding layers on top of that system that provide more accuracy and precision to be able to actually describe it, right? As it absorbs more and more things around it, right? As it grows as an asset class. So I think the journey started with, I think Willy Woo being a pioneer in on-chain, us following in his footsteps, and then us really together evolving a concept and a framework from that, right? Incorporating options, futures, price analysis, also macro, right? So cross-asset analysis to understand like how this, think of it like a balloon that is Bitcoin or the Bitcoin ecosystem, how it basically starts growing, and understanding where that oxygen comes from, right? Which is super important. I don't know, Will, if you have anything to add to that as well, because obviously you're a big reason as to why we're here to begin with. So
I think you pretty much nailed it. I would just say there was a question around on-chain and whether it's picking up everything because futures is now part of it, and that was my big learning because the last cycle I was too dependent on on-chain and I didn't have good metrics on what was happening on the futures market. So obviously that has changed now. I look at as much as I can, I try to draw a box around the whole system of liquidity. So what's happening in futures, what's happening in option, which is kind of backs onto futures, what's happening on chain, which is more of the legit signal of real investors coming in. Futures tends to be a mix of speculators and yield generators. Like I would guess $10 billion of capital is currently deployed into crypto to generate market neutral yield. There's all those sort of things happening within derivatives. And so there's that overlay and also tactical trader positioning and liquidations. And that tends to capture most of Bitcoin. On-chain tells you a lot about what's really happening between investors. But then you've got these other overlays. And I think that's pretty much it right now within the markets. That'll include everything, including MicroStrategy buying, because you can read that on chain. You like people often ask me, are you capturing the ETF? So you're capturing MicroStrategy. What about this? What about that? And it's like, look, we just put a box around the whole thing. The whole entire system's called Bitcoin's blockchain. When they buy, coins move on chain because it's a spot ETF. So we're capturing the whole system and how much capital flow is coming in. So yeah, that's what I try to do is capture the entire system and then look at different parts of it and how they relate together.
I think those are all the questions. So unless I missed something, there's a couple that came in at the very end. Maybe I might have actually missed one or two. But just for if we didn't answer questions, you're more than welcome to just respond as well through our contact that we have on the website. Obviously, Woonomics as well, right, Will? Or Twitter directly. We're always happy to answer any questions that come through. We're always learning through the questions as well, right? As we try to explain these things and look at it from different perspectives, we're learning, which is exactly why we're super happy to engage and do this, because at the end it is about exploring and figuring things out together. But
so we will try to upload this onto YouTube, so you can. We'll send it out on email, but we'll try and upload it onto YouTube so people can watch this. Just to close, if anyone who's subscribed to the product and has feedback, either type it into the chat panel or please email us, because we're very much in dialing in this product. I think we can do a lot of improvements to the product to the way in which we communicate all the data and the signals. It's quite challenging to get that in a very dialed in, easy to understand format. So we're working really hard to communicate what we're seeing through the numbers. So please consistently give us lots of feedback and we'll do our best to make improvements.
Absolutely. Always trying to improve. Thanks a lot, everyone.
Okay. Thanks for joining, everyone. Goodbye.